Good morning, traders and investors. Roger Scott here, Senior Strategist for WealthPress. Today's Thursday. It's July 20th. It's about 7:52. The market's not going to open up for another hour and 48 minutes or something like that. Remember, I got to do quick arithmetic in the morning here for you. Folks, welcome. Before we get started, very quickly, join our Telegram channel. Go to rogerscott.com/Telegram, or there's a link below this video if you're watching in the YouTube WealthPress channel. If you want to get these videos really quickly, like the minute they come out, join the Telegram channel and make sure to subscribe to our videos in the WealthPress channel. That's YouTube WealthPress channel. I post them there about 8:20, 8:30 every morning. Now, comment there as well. I will respond within 24 hours and I will say thank you. Moreover, and most importantly, I've opened up my VIP room to give you a second part of this video during the market hours where you can ask me any questions. I'll give free trades. It's for the summer. I opened it up, welcoming everybody. Today it's at 10 a.m. That's right, 10 a.m. Eastern time, just a couple hours from now. So there's a link above or below this video, and you can always find it in the YouTube WealthPress channel right below the video. I posted there personally. Now let's get into all of this. What are we wasting all of this time for with all this drama? So as you can see here, as I just mentioned, it's about 7:54 now. The market's going to open up in an hour and 36 minutes. I don't know where I got the hour and 48 minutes a minute ago, but again, it's still early here. Give me a break. I woke up an hour ago. The Nasdaq's down about 100 points. The Dow is up 37 points. Why is the Nasdaq down 100 points? Well, I'm glad you asked. Let me show you why the Nasdaq is down so much. It's because of Tesla. And look at Tesla. It's down 4%, and also Netflix. Now, I'll talk about both stocks, but both stocks have huge market cap. Netflix is down 6%. I hate to say I told you so, but I told you that technology is not as strong as it appears. And if you look at all these sectors, you will see here that consumer discretionary is still moving higher. I don't know if that's going to happen today. I really don't. I'll be very surprised if it does. But notice communication services, which Google has. It looks like it's topped out here and it's ready to come down. And I can also tell you with a 100% certainty, unless a miracle happens in the next hour and a half, that technology is going to be coming down. So there is going to be a heavy weight on the technology, communication, and potentially the consumer discretionary sector today as a result of those stocks. Now, it's really interesting, but there's no heavy technology stocks coming out today. We've got Johnson & Johnson, we've got Philip Morris, a couple of blue chip stocks, as I'll talk about right now. Here you could see that what's coming out today. American Airlines, Blackstone. So there's really no technical earnings to offset the downside, and that's what I'm actually looking for. I'm not really looking to see if there's any other tech stocks, but I'm looking to see if there's any tech stocks to add to the drama or to take away. But it looks like today there's just no focus on it, which means whatever happens to these stocks is going to be in fact impactful to the market, but I'm not expecting anything positive from them. Now, in terms of other sectors, I'll just show you the sectors earlier. I'll show you what I like right now. I'm still liking the industrial. It's still moving along and earnings are supporting it. I like the financials. They're coming out better than expected, but this may be a little too fast, too soon. Keep an eye on the financials. Real estate still looking good. The number yesterday, right here, the housing starts and permits, it was a little bit off. It wasn't off all that much. It was a little bit off. Just, they were looking for 1.48. They got 1.43. It's not like down by half. And here it was 1.48, 1.44. And then today you've got the existing home sales. So again, still bullish on homes and residential real estate, not bullish on commercial real estate. Now, one sector that I'm starting to really like, and I know it sounds like an old song and dance, but remember something. It took a little while for technology to soften up. We're definitely softening up. If that's the case, we may see a reversal in consumer staples. We may see a reversal in healthcare. Those are the two sectors that have been taking it under the chin, and energy too, with technology stocks rallying and rocking and rolling. But right now, we may have a reversal. Now, basic materials I'm still liking, especially if interest rates are going to be stabilizing, because that's really good for basic material prices. And industrial stocks have been doing well with earnings. We'll have to keep an eye on it. Hopefully it'll continue. But real estate I like. I like consumer staples, and I really like healthcare. If I had to pick three sectors that I'm bullish on right now, or four, it would be energy. I think energy is starting to come back up. These bottoms look higher than the previous. That's a very good sign. I like real estate. Utilities, I think, will still rock and roll a little. They've been lagging energy quite a bit, so I think they'll still kind of stay choppy. But I really like consumer staples right now. I like healthcare, and I like basic materials. And again, industrial could be a little toppy here, along with financials. But if earnings in the next couple of days justify price, you could see more upside on industrial and financial. Whereas basic material, we still have quite a bit to go. Energy, we have quite a bit to go, although I don't know if earnings on energies are going to be that great, but I like consumer staples and healthcare, and these are defensive sectors, so if money starts coming out of technology, it'll go there. Now, the bond market, I mentioned yesterday morning and the day before and the day before. I said if we break above 102, which we did, right here, there's a good chance we'll go up to 104. We broke 102, and yes, there's a great chance we'll go up to 104. I don't know if we'll break 104, but we did break 102. I'm pretty confident at this point we'll hit 104, this kind of an area, and then we'll see if we'll hit the 106, 107 area. But the next level up is 104. And remember, bonds are pricing in a rate hike with about a 99% certainty. So at this point in time, it is going to happen. And one thing about markets, if you take the uncertainty away, they tend to move very quickly. There's very little uncertainty in terms of what the Fed is going to do. Right now, all eyes are focused on earnings. And earnings, if the earnings are worse than expected, right, investors tend to flee towards the bond market because it gives them a flight to quality or safety. And we know that they're going to be slowing on interest rates, which means there's always a little drama between interest rates, utilities, and bonds and the stock market. But the stock market going down is actually beneficial for the bond market. That's called flight to quality. You can expect to see a lot of money coming out of technology into bond market, consumer staples, defensive stocks. It's been going on before I was born. Again, as far as earnings, American Airlines, Blackstone, Capital Financial, CSX, railroads. It's pretty broad, but you could see there's not a lot of technology. It's mostly blue chips. So far, blue chips have been doing a lot better than the market. Like as you could see here, they're still up 33 points, while the Nasdaq is taking it under the chin. And I mean really taking it under the chin. Let's talk a little bit about the preview and this will summarize a lot of what I discussed. And then I'll talk about my favorite ETF and give you an option, and also want to talk a little bit about what's on the table today in terms of Fed data. Disappointing earning results from heavyweight Tesla and Netflix weighted on sentiment, while investors are looking ahead to all of these earnings that are coming out today. And again, these earnings can shape the market, but there's really no news to offset on the tech side. See, there's no like if Amazon was reporting or Apple and the numbers were really great, well, we could say, well, we'll see an offset. But there's really nothing to offset technology today. So I think that these stocks will continue moving down. Netflix tumbled 6%, Tesla tumbled 2%. Musk said possibility of price cuts during turbulent times. He's not looking for the rainbow, and I'm not either. I think we're entering turbulent times, and inflation is still sticky, which means the Fed may have a lot more to do than the market is pricing in, and that may cause a bearish downside move. Economy was slightly lower than expected. Building permits, housing starts didn't really seem to offset prices of real estate stocks too much, and today you have existing home sales. We're now pricing in a 99.8 probability of a 0.25 basis point rate hike. That is not changing. We're going to see earnings today on Johnson & Johnson, Abbott Labs, Philip Morris. I will be talking about this during the VIP room today that's happening at 10 a.m. The link is below this video. You do not want to miss out because I'll be talking about all of these big stocks that have already reported or are reporting. I'm going to be giving you levels and things to keep in mind as we go through this. You've got manufacturing data today, so keep your eyes on the basic material and industrial stocks. As I mentioned, you've got existing home sales and you've got jobless claims. As long as the jobless claims number is near the 240, 250, let's see what the expectations are. As long as they're not 300, 320, we should be okay. Yeah, 241, we should be okay as long as they stay within that range. If they're a little bit higher or lower, it's okay. Europe is tracking technology stocks in the U.S., which means it's going down as a result. China closed lower, extending losses, fourth straight session. Economy failed to impress investors. Not good, not good. It's going to wait out here. Japan declined again, losses by chip-related stocks. And by the way, semiconductors, I want to show you something while I haven't forgot. Look at technology before today's event. It's supposed to come down today. It came out yesterday. It's already down 0.44. But more importantly, look at chip stocks. Notice how we made a swing high here? Look at SMH. That's the semiconductors. They're already down quite a bit today, and they've been struggling around here. So again, I think this is algos trying to squeeze us into chips, but I'm not seeing it. I'm expecting us to come right back into this base, as I predicted several weeks ago, that this is not going to be sustainable and we're going to come down. I'm pretty confident of that right now, actually. Again, China's not doing well. Indicating a global demand, sluggish global demand. Folks, Elon Musk talking about economy. What did Elon Musk say? Let's see here. Turbulent times. China talking about sluggish economy. Meanwhile, technology's doing this. I'm not buying it for a second. I think you're going to see an undoing of all of this communication, consumer discretionary technology. I think it's all going to come down, and you're going to see a reversal, and the larger, broader market cap stocks like consumer staples, healthcare, I think they're going to see another rally because we're still in an inflationary market, and we're going to stay that way. Now, I like right now, I'll tell you what I like. I like healthcare. Why? Healthcare is breaking above the high. I like healthcare and consumer staples, but I like healthcare. Let's look at it right now. See how it's breaking up? There's a few things that I like. Let me show you what they are. I like the consolidation. I like the ascending triangle. I mean, the symmetrical triangle on the long-term weekly basis. On a daily basis, I like how we're breaking above this level here. Now, XLV looks good and XLP looks good. Let me show you XLP. Looks like it's consolidating. Actually, to be honest with you, I like them both evenly. Now, there is a head and shoulders here, but I think this has already come down, and I think it's going to come up to the 76, maybe the 78 level. We still have some congestion here, and I think we're going to be staying within this channel, which means we've got a lot more upside. So let me give you options for both. I'm going to give you options for consumer staples. Let's go to the monthly. These have about 30 days left. If you don't get a pop in 9 days, 10 days, just get out of them. You want to go with the 75 strike price. You can get it for under $1 right now. Now, for healthcare, same thing, 29 days. If nothing happens in the next 10 days, just get out. And we would look at the 134s. Plenty of open interest, plenty of liquidity. I don't even look at volume and open interest till I look at the spread between bid and the offer. And the market's closed right now, so the spread is wide. But give it an hour or two after the opening, it'll go higher. Look at implied volatility, by the way. It's 11%, 11%. Look at XLP real quick. Look at implied volatility, 11%. Look at some of these stocks like Tesla. Look at implied volatility, 58%, 44%. It's nutty out there. How about Netflix? Let's see, 52.28. So you're buying these options a lot cheaper. There's a lot less intrinsic. There's a lot less implied volatility in these options. So if the market moves, you will end up making a lot more. So again, I like consumer staples right now. I think they're going to come higher at the expense of technology, and I like healthcare. I also think it's going to come up. I also believe basic materials, if the news is positive today, there's a good chance it'll break out above these levels and pull what industrial stocks have pulled. I think industrials have less to go. I don't see a major catalyst here, but I think we have a catalyst for basic materials, which would cause them to go higher above this level just a bit. Looking at the Dow Jones, we broke up, but I think we're going to come down. This is classic algo plays right now. This is going to come right back down to the base, so be careful of the broad market. Now, folks, in just a few hours, literally in just a few hours, I'm going to be live in my VIP room. Actually, It's happening in less than 2 hours. Don't miss out. The link is above or below this video if you're watching on the YouTube channel. Now, I've got a treat for you, folks. At 1 p.m. today Eastern Time, I'm going to cover what could be a financial opportunity of a decade. Some of you may roll your eyes when you hear about it, but there's something happening right now that only occurs with our economy. Yes, it only occurs with our economy when we're coming out of a potential slow period, recessionary, inflationary period. The S&P is now up about 20% off the bear market lows. It's up 20% off the bear market lows. And dating back to 1953, following every recession, and we've had 9 recessions, we've seen the great divergence. We've seen smaller stocks rally ahead of these larger stocks. And it's starting to come right now. It's underway again right now at this moment. And I cannot wait to share all the details with you. Come 1 p.m. Eastern Time. Follow the link below. Give away my #1 great divergence stock for free, no cost. Hedge funds. Let me tell you, hedge funds have been loading up on this ticker symbol. You cannot afford to miss this critical opportunity. It's happening at 1 p.m. Eastern Time today. You guys are going to love it. It's brand new. It's very cool. Follow the link, and I'll see you there at 1 p.m. If you have any questions, send me an email, support@marketgeeks.com. Like, subscribe to our YouTube Wealth Press channel and our Telegram channel. Bye. Have a great Friday Eve, as I like to say. Bye.